Just make a couple of more short questions about current economic issues, monetary issues. One would be, why are we so obsessed about changes in interest rates? I mean, it's not, I don't think it's ourselves, but everybody in our profession, central bank watchers, major academics are still engaged in replicating models of the economy, very much focused on how tiny changes in interest rates, policy rates, affect the economy.
Let me respond to this first, if I may, one. I think with the obsession in part arises because many economists have forgotten what an interest rate is. An interest rate is a price. And they have therefore forgotten in turn that if a price is going to change, either the quantity supplied or the quantity demanded has to change. And they think that simply pluck these price changes out of the air. Thus, they don't think what is the counterpart of the change in the central bank policy rate. It has to be a change in something the central bank does to supply or withdraw funds from the system. And they thus are focusing on the wrong question, putting the question wrongly. And that can be terribly misleading, because there has been a sudden rash of papers claiming that raising interest rates raises inflation. How did they get to this answer? Because they look at the statistical relationship between interest rates and inflation. And indeed, you can very easily find the close positive relationship between interest rates and inflation. But this is an error because it arises simply because they say, let us change interest rates, or interest rates have changed, let us see what happened. They don't ask why the interest rate change, and that is very important. That's why the understanding of economics must underlie the econometrics, which one mentioned. We should ensure the econometrics the economics is understood thoroughly, because if you don't understand your economics thoroughly, then teaching someone to use econometrics is simply like teaching someone to use a gun without telling them what the end of the board comes out of.
Sorry, Tim, just for a second. So my question is, why this obsession on focusing on the price, as you said, on interest rate, rather than the quantities of money provided by the bank?
I'm an economist, not a psychiatrist.
Well, can I just say something on this front? Because yes, there is this idea that you can forget about the quantity of money. Among some of the Federal Reserve, the 13th Federal Reserve, and some of them they never look at money. Never.
Later central bankers. Yeah.
And they say, what matters is the rate of interest. Now let me tell you something which I know this is true. If you, I'm not a mathematician, I'm not a statistician, but I do look at evidence. If you do a regression of the change in real demand, and you regress that against the change in real money, okay, or the change in real broad money, or the level or change in any interest rate, I can tell you in every regression you do, the money variable will dominate interest rate variable for any country, for any period. That's the answer to these stupid articles, Jeffrey. That's the answer to them.
Well, in part it is, of course, but remember economists often talk about what causes what. Does money cause inflation, or does money simply rise exogenously? And that actually can be a very difficult question to answer, and this is where history comes in. Because if you take different historical periods with different institutions, including different exchange rates, we can then test the theory against the changing institution and see whether money is causing inflation or inflation is causing money. This was very important at one time. Happily, I think the controversy is now behind us, when many economists applied what were called causality tests. Alan Waters, the very great British economist, correctly pointed out they were not causality tests, they were tests of temporal precedence. What came first? But temporal precedence is a much less snappy term than causality, and causality caught on. They then applied these tests and discovered that in some cases, some countries I should say, income, nominal income in money terms led money. In others, such as Britain, there was no clear relationship. So it seemed to be clear to these people that money did not cause inflation, simply money accommodated what was going on. What if we applied some very old economic theory, a theory that was developed, as most good economic theory was, by a Scotsman, in this case David Hume, to open and closed economies? We said what was crucial in distinguishing between these two periods was the exchange rate regime. If we separated the periods into fixed and floating exchange rates, we could then see that money was causing prices. The explanation is very simply, if you're a small economy an open economy, then money flows to and fro across your borders according to what's going on in the rest of the world, possibly in your economy, if you have a fixed exchange rate. You can't control your own money supply if you fix an exchange rate. If, on the other hand, your exchange rate is free to float, then the central bank has control over the money supply if it chooses to exert it, and then it has causality. So history is also important in understanding econometric data and important things such as the causality, the direction of causality between changes in money and changes in inflation.
And I'm 100% agree with that. I mean, one has got to look at evidence, one has got to do some econometrics, that's just a place for that. There's also a place for history, and it's very important in these questions of causality. One of the criticisms that one gets repeatedly of this quantity theory, monetarist point of view, is that the level of spending is determined by other things like the rate of interest or fiscal policy or something, and then the quantity of money adjusts to this. So what the sophisticated theoreticians say is that the quantity of money is endogenous. And then you try and find out what they really mean by this, and what they mean by it is that banks can give overdrafts. So if, for example, a company has got a financial problem, it can run down the overdraft, it can increase the overdraft, and that then means that a new money balance is created alongside the, and so they say the quantity of money adjusts to the needs of trade and so on. In other words, this is all about the private sector. Endogenous is all about the private sector borrowing from banks and using up overdraft lines. That's what this theory is all about. I'm sure Jeffrey will second me on this. There have been dozens and dozens of hyperinflations in which the price level has risen by more than 50% in a month. There have been dozens of these episodes, and not one of them has been associated with excessive growth of credit to the private sector. They've all been due to excessive budget deficits and borrowing by the government from the central bank or the banking system. What was the direction of causation in the hyperinflations? Obviously, from the government overspending to the quantity of money to spending to inflation. Obviously. You can't explain hyperinflations by endogenous money. Nonsense.
That's very actually more general extension of that point, which is that, again, in looking at direction of causality, it's often important to look at big changes. And hyperinflation, very rapid inflation, show very clearly money growth arose because of changes in government behavior. We can sometimes see changes in the private sector leading to changes in money growth independent of what the government does, but they tend to be small. You know, the great and currently unfashionable American economist Philip Kagan, so with us actually, in his very early work looked at determinants and effects of changes in the stock of money in the US, 18-something to 19-something is the title of the book. He found that every big monetary fluctuation was due to central bank or government action, and the trends in money growth were due to central bank or government action, but small fluctuations were equally likely to originate in the private or the public sector. So again, it's very important to think, what are we going to explain, what's important? And of course, we need to think also of the distinction, and this I'm sure will come out in the econometrics that you're going to be taught, the distinction between economically significant and statistically significant. Significance in these settings means two entirely different things, and we should never forget.
May I just say that, if I'm not wrong, please correct me if I am.
Of course.
Before the 20th century, especially before the 30s, and the Keynesian theory just dominated the academia, basically. This was the mainstream. This was actually this approach to inflation, this monetary approach to inflation, was very well known by all and sundry, if I may say, and specifically even before David Hume put it. May I say, Jeffrey, that the scholars in the School of Salamanca, they also put it very rightly, because they experienced themselves that the Spanish crown, after the discovery of the Americas, was importing a massive amount of gold and especially silver, and they showed how they proved how this was accompanied by rapid inflation. So they saw this causality between the influx of precious metal, more money, and then followed by an increase in the price level. So this is quite an old story that we have tended to forget in the 20th century